The government is spending $30 billion on mortgage bonds in 2026. And this is one of the biggest reasons why fixed mortgage rates don't just follow the Bank of Canada. Here's what's actually happening. When you get a fixed mortgage, your lender doesn't just keep that loan sitting in their books. They sell their insured mortgages to something called the Canada Housing Trust. That frees up their money so they can go out and lend again. Then those mortgages get bundled up together and sold to big investors like pension funds and insurance companies. The bundle is what's called a Canada mortgage bond. Now here's the part most people don't understand. These bonds are government backed through CMHC, so they're considered very low risk. Because of that, they can trade very close to Government of Canada bond yields. And this is where it directly hits you. Lenders price fixed mortgages based on a simple formula. Mortgage rate equals bond yields plus lender spread. That bond yield is basically the lender's cost of money. The spread is their profit, risk, and operating costs. So if the bond yields go up, fixed mortgages rates go up. If the bond yield drops, fixed rates can come down. That's the real driver. So when Ottawa steps in and buys up to 30 billion of these mortgage bonds, they're acting like a massive consistent buyer in that market. That helps keep bond yields more stable, which can help fixed mortgage rates from rising even more. Not control, but influence. So if you're renewing in 2026, here's what actually matters. Watch the 5-year Government of Canada bond yield. That's one of the best early signals of where fixed rates are heading. Ask your broker if the gap between bond yields and mortgage rates is wider than normal, because that could mean there's room to negotiate. And don't assume the Bank of Canada tells the whole story. Fixed and variable rates can move completely differently. If yields are high, a shorter term might make sense. If they stabilize, locking in gives you more certainty. So if you're renewing in 2026, are you going with fixed or a variable rate?